for Time Equities, Inc., and has been actively engaged in multiple facets of the commercial real estate business for the past 15 years. Max, we happily welcomed Max back in 2015 after he took a short break, from us, and he can maybe go into a little bit of detail about what he was doing in between. But when he rejoined in 2015, he now is co-leading a national acquisitions and asset management team at Time Equities. And since returning, he has acquired in excess of 3.5 million square feet of real estate across 11 states throughout the U.S. Max's responsibilities include sourcing and formulating and executing business plans for a diverse national real estate portfolio. He has significant expertise repositioning and underperforming assets, including multifamily, urban retail, and office properties, as well as converting formal industrial, mill, and manufacturing facilities to many contemporary uses. So, Max, enough for that introduction. I'll turn it over to you for a moment so that you can enlighten us more about your background and how you found yourself to Time Equities to begin with, as well as coming back.
Good afternoon, Alex, and everybody else. First off, hope everybody's staying healthy and safe, and thank you for the opportunity to participate today in the TEI Virtual Spirit Series. So I found myself at Time Equities originally as a law student attending the Cardozo School of Law at 55 Fifth Avenue, which happens to be the lower floors of the office building that we're in New York, where our headquarters is. One summer between my second and third year of law school, Time Equities was looking for a legal intern, and I walked my resume upstairs and was hired. I guess I tried to charm them and was hired and worked for Francis and Bob Cantor for many years, and then left for private practice before circling back with an opportunity to head up an acquisitions and asset management team at Time Equities. Learned a lot from Francis and Bob and the core investment philosophies that we practice every day at Time Equities, and happy to sort of talk about how we put those to work, both in operations and future investment opportunities. So as Alex was saying, I co-lead an acquisitions and asset management team that has acquired over 3.5 million square feet of commercial real estate. The portfolio consists primarily of multifamily, office, and industrial assets, and some ancillary retail across 11 states. One of the unique attributes of TEI is that the acquisitions team who sources the opportunities is also responsible for the implementation of the business plan and the asset management of the property. To that end, we have a good view of how the portfolio that we're responsible for is performing in this new environment and what opportunities we see for investment coming down the pike. I thought I would start the afternoon by giving a brief overview of the performance of the different classes of assets and then move on to future opportunities. So in April, we have a lot of raw data, and when comparing rent billed and revenue collected, my portfolio saw the following averages. For office, 98 to 99% collections, multifamily around 94%, and industrial at 79%. The ancillary retail portion of the portfolio is a very small sample size, but is relatively consistent or slightly better than what's been reported from our publicly traded counterparts. For the most part, through May so far, the trend seems to be in line with April, so I would expect that the May averages will come in a similar capacity. Within the categories of multifamily, industrial, and office, different assets performed differently. And what we saw was it has to do with the subtype of the property, the class of the property, and also the location of the property. I'll give you a few examples. In multifamily, we're seeing our highest quality properties, which I would call TIA, or maybe the market views them as a B plus property, have performed the best. At those properties, we're seeing anywhere from 97 to 99% collection rate. And that's similar to a period in time where there wouldn't have been any disturbance from COVID or economic disruption. When we move on to B minus or C plus type of multifamily assets, we're actually seeing those perform very strongly as well in the low to mid 90% range. And that's throughout both the Northeast and portions of the Midwest. Where I have sensed a little bit of weakness in the multifamily, although it is not a large sample size given my portfolio, is with New York City specific residential tenants. And I think there's a couple of factors to weigh when looking at that. The tenants in my particular portfolio seem to be quite attuned to the pause in evictions, the lack of the ability of the landlord to enforce payment even though rent is due right now. And I think we see some tenants that are taking advantage of those realities accordingly. I found the industrial sector to be the most interesting and variable by the property subtypes. By and large, the tenants that we have who are focused on national manufacturing or distribution, credit type tenants, we've seen very little delay in rent payments from those types of tenants. But when you compare that to flex industrial space, which is populated by small businesses or maker type tenants. And when I speak of maker type tenants, I think of woodworkers, fabricators, upholsterers. A lot of times the flex industrial properties will have a quasi retail component, such as a fitness studio or a yoga studio. Those that have not performed as well, maybe because of the small business type of finances, the ancillary retail component of some of those businesses, but that's where we've really seen the weakness thus far in the industrial sector.
And Max, I'll actually interject real quick. I know this may go a little bit off topic, but clearly there's tenants that are either late in payment or not paying at all. And the good thing is it sounds like a good portion of our portfolio and the tenants in them are actually paying on time and in full. But what sort of strategies are you using to communicate with these tenants that are either not paying and or paying in part or not at all?
Well, it's a great question, Alex, and I think it's a multi-pronged approach. One thing that we found in April was the more you communicate, you can tie a direct sort of correlation to payments coming in. So we were in constant communication with many of our tenants through the month of April. And it was beyond just making requests for payment. We also reached out, although the goal was to prod payment, to educate them as to local and federal government assistance that could be available to them. The most talked about is the PPP loans, but there were also other small business loans available to them. We treated each tenant is unique and their situation is unique, so we didn't make a broad brush sort of concession or offer to tenants. We dug in and dealt with each tenant's needs and situation accordingly. First and foremost, we started with not really talking about rent abatements or forgiveness, but really if somebody had an established need or their revenues were turned off, this is a temporary situation, and we tried to frame the request as a rent deferral rather than any sort of abatement. Another opportunity that came out of that is when we're discussing their lease and payment arrangements, it gives an opportunity for us to look at the lease and at the same time, from the landlord perspective, see what may be problematic in that lease or a situation that doesn't work well for us. And there can be an opportunity now to address that as we're having a dialogue. A couple of easy examples that I dealt with recently. One is extending the term in exchange for some sort of forbearance or deferral in rent for a tenant who's either expiring or been a good payer. Maybe there's somebody we want to keep around for a long time. Also, if there's a particular clause in a lease, such as a termination option, it gave us an opportunity to maybe go back and renegotiate those terms. And we've had situations where we've done that successfully thus far.
So it sounds like the silver lining in all this, in some cases, is that many of these tenants, obviously, when we acquire properties, we're inheriting them from the previous owner, and had no control, obviously, in how the leases were set up in the first place. So here we're actually able to kind of mid-term, or depending on wherever we are in the lease, cycle, to improve the quality of the leases, which ultimately improves the quality of the tenants and the building overall. Which, and the silver lining is that when we come out of all this, we'll have better quality leases in place with hopefully better tenants, and it'll improve the quality and value of the properties.
Sure, and it's been in select circumstances, but we've still, made a big effort to try and do that. Another example I can give is there was a tenant in Miami, actually, who we had an ongoing sort of disagreement over a commencement date and rent that was owed. And when they reached out to us for some release and deferrals, it gave us an opportunity to all sit down and hash out that issue. And we came up with a mutually agreeable solution, which included us receiving a rather large payment going into the deferral period, which was helpful from a cash flow perspective. So it's not every situation that we can do this, and certainly it's not in every situation that we would want to perhaps extend the term, but where we can, we're trying to be, as we always are, opportunistic and do something beneficial if we have the opportunity to.
So if you look at your overall portfolio and take into consideration asset classes and geographic location, are trends showing in certain submarkets and or certain assets that the COVID disruption is more of a short-term dynamic, 1 or 2 months nature, or is this going to be more of a prolonged multiple month, could even be through the end of the year or even further dynamic as it relates to the portfolio?
Yeah, let me start with office, actually. In the office portion of my portfolio is probably where we've seen the least deviation. The primary location of the assets are Maryland, Virginia, and Ohio, and we saw very little payment problems on any of the months from March, April, and May that were related to COVID. On the flex industrial side, which is where we've spent a good portion of the discussion, I definitely saw a difference in the locations of the properties, whether this was a 1-month event or 2-month event as far as April is concerned. So did the properties really begin to have significant impacts in March, or was it really in April? So some of the northeastern properties, it really started very early in March, and where they were disrupted. So by the time April came around, there had been serious disruptions in the revenue streams, and I think the collection numbers show that out. Whereas we have a flex industrial property in Indiana, right outside Indianapolis, that property, it was really an April event only. And while we did have a few tenants reach out to us in March, the vast majority of the month was not impacted, and it was just an April event.
All right, well, thank you for that. So switching over from current portfolio, and let's talk about maybe for the next, 10, 15 minutes about a going forward strategy. Where are you seeing, where could you and where are you seeing opportunities today if you are seeing them? And what would Time Equity's approach be going forward in terms of immediately reacting or, sitting back and waiting and seeing what happens?
Well, there's certainly opportunities out there, but I do think it's relatively early still. One of the things I think how commercial real estate markets maybe differ from, let's say, the stock market and the equities market is disruption takes a little bit longer to work its way through. So it's not as if there's a lot of opportunities right now where people are just throwing up their hands and offering you a fire sale. And the reason it takes quite a while to work its way through is as tenants have issues and owners maybe in certain circumstances don't have the funds to pay their debt service, that takes a long time to react, because most owners would carry a property for several months, even if they don't have sufficient cash flow. Then the banks need to start their process by putting pressure on the owner, whether it's defaults, foreclosures, etc. And it's going to be more of a lagging indicator than a leading indicator. One of the places that I focused on as far as current deal flow is where there are situation-specific opportunities in the market where a seller perhaps was in the market to sell their asset prior to COVID because there was some sort of pressure on the property. And this really detrimentally impacted the marketing process. And there's a situation where they have to sell. And I'd call that a situational seller. Certainly my phone has been ringing much more lately on people who are pursuing the sales of debt products, whether it's a performing or non-performing loan or mezzanine opportunities. There seem to have started people reaching out and talking about new joint ventures and recapitalizations of properties. I also think as the credit markets right now are a bit frozen, that could create an opportunity where you see more sale-leaseback transactions because companies are otherwise having difficulty procuring debt. So I think there's going to be a lot of opportunities. I think it's still early. We're certainly every day actively sourcing and looking for those. I think the most important thing we can do is really stay true to our sort of defensive nature in acquiring real estate. We've always put really cash flow first. And when I think of the three things that I look at with deals, it's generally, what's our in-place income? Is it an above market cap rate? Two, I want to be sure that we're compared to competing product or our peers in at a low basis. I think if we're in at a low dollars per square foot, it really gives the ability to sustain the down cycles. And do we have upside in that product, either through, is our occupancy below its peer group, or are the rental rates in place below what the market is? I think as we look at those three critical factors, we stay true to what we've always done. There's going to be a lot of opportunity as we exit the immediate effects of the pandemic, and we'll apply our principles. And I think we're going to see some really good opportunities that, as they say, and Francis had taught me this very well, that most times in real estate, your money is really earned on the buy, and we want to buy low and in accordance with our fundamentals. And I think we're going to have a lot of opportunity to do so coming out of this in the coming months and years.
Okay. Let's switch topics actually again real quick, and I know this is something that we may not have discussed, but from a capitalization standpoint in terms of internally time equities. We of course have a tremendous amount of internal core capital and financing capabilities. And then also we have friends and family and our broker-dealer advisor network and so on and so forth. Do you see, well, I guess the question here is, will any acquisitions going forward throughout the course of this year be impacted on our inability to source either financing or investor capital of any kind, or are there sufficient means to take advantage of the opportunities that we would want to?
Yeah, I wouldn't foresee any disruption from our point of view in that. We're well capitalized. As you know, Alex, most of the acquisitions that we've done in the last several years have been really all cash acquisitions, and we haven't looked to the capital markets and financing instruments at acquisition time. We've really, for the most part, implemented our business plans and then looked to recapitalize through a financing 1, 2, 3 years down the road. So I don't think our capital will hold us back in acquisition opportunities. I think we're well capitalized. We don't need the debt market necessarily to close deals. We've made cash offers and we'll continue to do so. And I think it's an important aspect of our business plan that should make us an attractive buyer for sellers, and also give us the ability to capitalize on opportunities quickly when they arise.
Okay. All right. Well, thank you. All right. Well, we're approaching a half hour here. So what I want to do is, in essence, everyone's time. Again, I want to thank everybody for joining us today. And Max, I don't know if you have any closing remarks or anything before we open it up to Q&A to answer some people's questions.
No, I think my closing remarks would be that, look, in the short term, we're going to have some sluggish times and situations we need to get through. But I do believe we stay true to our core values and invest with low basis and a focus on cash flow and unleveraged returns. I think a lot of our properties are positioned well to benefit from when we exit the pandemic. Changes in the macro economy, such as onshoring of manufacturing and distribution chains, could have a positive effect. And I think we're going to exit this quite strong and are in a good position to capitalize on opportunities as they arise because of this.
All right. Well, thank you. All right. So I'll give everyone a few moments if you want to enter in any questions in the chat box, and we'll start with one. So Max, going back to the existing portfolio, as well as looking forward to new acquisitions, do you see? And I guess this could be drilled down onto one specific type of asset class, and then it could also be expanded to different ones as well. But we can start with office. But in terms of future office leasing demand for space, do you see that being impacted by COVID in terms of now everyone working remotely, and whether or not that will be productive going forward? That will create less office space demand and more people working remotely. And then if you wanted to elaborate on that further, how do you think going forward, industrial and retail leases will also be structured on a going forward basis, considering, sizing constraints?
Let me tackle office first. I think it's a great question. And I've certainly talked to a lot of people, business owners, other people in the market, and it seems like we have mixed opinions. I totally understand the people whose perspective is that we've learned how to work remotely, efficiently. That could coincide with a lack of demand for office space. But I also conversely believe that some of the density that we have packed people into in offices may not be able to be sustainable in the future, and that businesses, while more people are working remotely, at the same time are going to have their per square foot per person square footage number increase to accommodate that we need to be sort of further away from each other. So the question is, does that balance out or create more or less demand? It's definitely something we're discussing and analyzing every day. And there's two competing forces. At the end of the day, perhaps they balance themselves out, but with collaboration, I don't think that office is going to see a significant contraction due to the expansion factors. Also, similar about 10 years ago when co-working was starting to come of age and telecommuting, there were a lot of camps that believed office demand would go down greatly because of that. And that isn't really what we've seen happen in the marketplace. One area I think will be interesting to view isn't really the space, but do people prefer more sort of suburban office? Hasn't been the most popular asset class in the last few years, and the urban office centers have really blossomed. Will that change due to density and mass transit and things like that? Will we see people flocking again to suburban office? I think there could be an opportunity there. I think the pressures on retail, though that's not really my expertise, is also when you look at restaurants and uses of a similar nature, spin studios, they also are going to struggle with density, and will they have to expand their footprint. As far as on the industrial side, I like where the flex type of space is going. It was certainly sensitive to the economic contraction we experienced, but I also think it's very well positioned in the future where you have businesses with fewer people that add space, and they offer a economic alternative to office to really gain some traction there, especially as the dynamic changes with onshore manufacturing and things of that nature.
Okay. I got another one came in. Being that you have a legal background, and of course, over the last few months, the government has encouraged landlords to not take any sort of legal action against tenants that aren't paying or whatnot. But going forward, if tenants continue either to ask for rent relief or not pay at all, what sort of legal ramifications does the landlord have on their side to take action, or are we still in kind of a pause mode and not able to actually act on it?
I think there's a couple of things here to flush out, and it also varies by state. But for the most part, nobody has said that rent is not due and payable from a governmental perspective. Most states have encouraged or made it impossible for the landlord to collect if somebody doesn't pay, either because, for example, the courts are closed, so we have no way to enforce it through a legal proceeding. However, we've already, in certain circumstances, defaulted tenants that we couldn't come to an agreement with, and have prepared to take sort of formal legal action as soon as the courts reopen. In select cases where we couldn't come to an agreement and a tenant refused to pay, the formal default notice was effective. So I think in the future, we're going to treat it like any other time. And communication with us is key. We're open for reasonable accommodations, but ultimately, if somebody doesn't pay, doesn't communicate, we can't come to an arrangement, we're going to go forward with the legal process. And in certain circumstances, we've started now, and we know that in those circumstances, we may or may not be able to enforce it because the courts may be closed, but definitely the legal process is on the table and a tool for landlords, and absolutely will be used where it's needed.
All right, seeing what else has come in here. Let's see here. I know, many local investors of ours are familiar with the Connecticut Bridgeport portfolio. Is there any, can you give any more insight onto that in terms of how that's doing and business strategy going forward?
Sure. So the assets.
And I guess on that too, are we still looking to acquire more in that area as well?
Well, I think we selectively look at opportunities in all areas as they come up. My conversation on the northeastern sort of flex industrial properties were specifically geared towards two assets in Bridgeport, which were the Bridgeport Innovation Center and Bridgeport Trade and Technology Center. So those are the two where we see the observations I made about flex industrial. The downtown portion of the portfolio, which is a sort of core commercial and residential component of downtown Bridgeport, has basically performed consistent with the averages that I talked about. The residential portion, which is very sizable, was in the low 90% collection rate last month. And the retail portion of that portfolio was about 45%. In that portfolio, the commercial tenants consist of a lot of local restaurants with sort of mom and pop ownership, and they've been closed since March. So those are really the most difficult situations to work your way through. But at the same time, we have a large Citibank branch there that anchors the retail tenancy, which is why we performed probably better than the reported averages from publicly traded retail and mall REITs in that perspective.
All right, very good. 1:33, so I think we're right on time.
Great.
So I'll wrap up the Q&A for anyone else that has either questions that were unanswered or they come up after the math. You can either email myself at Anderson, it's ANDERSON @timeequities.com. Of course, I'll let Max give his contact information after this. As it relates to, this is also recorded as well, so we can make this available to all of you if you'd like to have this, in your files. And then also, as for next week, we're going to continue our Spirit series with Peter, who heads up our design and innovation team. And he can talk about various projects that we've been working on, both pre and post COVID, on a going forward basis on specific properties. And then we'll also have another one of our acquisition specialists, Aaron Medeiros, who's another director of acquisition and policy at Time Equities, who's been with the company for, I want to say, he's been over the company for longer than I have, so definitely over 10 years. So he's probably going on 12 to 15 years, if not more. So we'll send out details on that. Max, why don't you share your contact info if people want to contact you directly, and then we'll wrap this up.
Sure. It's my email address is mpastor, MPASTOR, @timeequities.com, and feel free to give me a call in the office, 212-206-5693. With any questions. Thanks for the opportunity today, Alex, and look forward to speaking with and hearing from anybody who was on the chat today.
Great. Well, we had quite a few. I think we had close to 50 people log on. So good attendance. You draw a good crowd.
Great. Thanks for the opportunity again.
All right. Bye, everybody.